Assalamu alaikum. My name is Abdul Wahab. So in this presentation, I need to make a video on financial management. There was assignment on CLO3. So in the assignment, there were two questions was provided. So let's start, and I will explain that how I solve all these questions. There was two questions, question 1 and question 2. So if I uh, if I will say in question number 1, part A, overall they ask me about means ke the year 1, year 2, year 3 and year 4 में they given me in an assets price 50,000. Their life is 5 years. So they they give me the data that in year 1 depreciation will be 20%, in year 2 32%, and so on all of that. The requirement is I have to need to compute the after tax cash flow from disposal. So I calculate the answer in part 1, how to calculate the after tax cash flow from disposal. So in year 1, year 2, year 3 and year 4 I calculated the depreciations. So asset is 50,000, 50 into 20%, and so on, you will see. So accumulated depreciation was 41,360. Then in step 2 I compute the book value. So fixed assets price was 50,000 minus accumulated depreciation. The WDV will be $8,640. In step 3 I will calculate gain or loss on sale. So sale price was given 5,000, book value 8,640. So there was a loss on sale which is negative $3,640. So if I obtain a loss, the tax, so I no need to calculate. I don't need to give the tax as an expense. I will record as a tax asset. It will be an asset for me. So if I will a loss, so tax rate is 20%. So tax shield for me will be $728. So the net loss will be for me after tax proceeds sale price plus tax shield. So 5,000 sale price plus 728. So final answer after tax flow from disposal will be 5,728. In the next part, they ask me explain how the concept of incremental cash flow in estimating the incremental cash flow of a project. So it ensured that only project specific impacts are considered, ignoring sunk costs and unrelated expenses. For example, when we calculate the present value of cash flow, so we took specifically incremental expenses, not sunk cost or fixed cost or past cost. We don't took these expenses. It highlights changes in revenue, operating costs, taxes and working capital due to the project, as well as it helps in avoiding double counting of existing business cash flows. It provides a clear measure of project profitability by focusing on what is added. So when also we make a capital budgeting, we evaluate by calculate the net present value, internal rate of return, as well as payback methods. So in overall, incremental cash flows allow managers to see the true economic impact of the project and make more rational investment decisions. In part C, they ask me factors, which factors I consider to choose a project using incremental cash flow approach. So number 1, I will see positive NPV. I will make a comparison of internal rate of return versus cost of capital, that what I bear the cost of capital and what I will return from the project, as well as I will see payback period, relevant and irrelevant cost, working capital requirements, how much capital I required for 5 years or 4 years project, as well as what is opportunity cost. I have to see risk and uncertainty factors, residual or salvage value. So overall I see all the. Let's come on question number 2. I have to, in step 1 I will calculate total cash inflows. So in the question they give him in cash flows $2 lakh accumulated receivable collections will be $100,000. So beginning so total inflows is $300,000, and cash flows which I have need to pay back account payments $200,000, wages and salaries. I have to pay interest payments, so total outflows will be $350,000. So in step 3 I will calculate compute net cash flows in inflows minus outflows. So there is a negative cash flow which is $50,000. In part B, 5 options when a company has excess funds means if a company generate a revenue or have a money, so where they required to invest their excess funds. So number 1, invest in marketable securities में they could invest if they have any debt, so they can repay it. Reinvestment in the business they can, or if they have excess funds they could give dividends to their shareholders, or can repurchase the shares of its own company. So any 5 options listed above means all these means a company. If a company there are 5 options, so if a company take any benefit from all of 5 these, if it consider that it will be more better if they give a debt, so it should be a give a debt. Or if they need that we should give the dividends to shareholders, especially in case of listed companies. Listed companies prefer to give the shareholders, so they gain a confidence on it. In part B they are asking about 4 rationales for financial planning in uncertain environments. So if there are uncertain environments, liquidity management, we have to calculate liquidity management, business continuity, risk assessment and flexibility, as well as investor and lender confidence. So liquidity and ensure sufficient cash to handle sudden revenue drops or unexpected expenses, means a company should have enough funds or cash to handle revenue and expenses. If revenue decrease, so or expenses increase, so they can easily manage it. Or business continuity, they should have a backup plans or enough excess funds that their business should be run in the future. Risk assessment and flexibility, they should be make a risk assessment for their business. So I think it will be a great presentation from me. I thank you very much. I hope it will be beneficial for me, and thank you. Allah Hafiz.